So I think that I mean, in a hypothetical future where Bitcoin is very, very large, that has a shot at fixing it in the sense that when politicians overpromise something without knowing how to pay for it or something like that, or they want to cut taxes without cutting spending, that has more immediate feedback loops that become apparent.
Mm,
And so I think a variable that the public would consider in their voting is just being generally more fiscally aware, and basically being able to assess politicians. But in the current environment with a flexible ledger, we assess politicians differently than we would if politicians literally had to like balance the budget or maintain very low levels of debt because they're dealing with like a hard currency.
Lyn Alden delves into the intricacies of fiscal responsibility and inflation's far reaching implications. She raises crucial points about the consequences of politicians' economic decisions, shedding light on the challenges faced by the public. Alden explores the often overlooked aspects of inflation, emphasizing its impact not only on savings, but also on individuals' contractual income streams. Through historical insights, she illustrates the profound influence of technology on global financial systems, highlighting the need for rapid digital settlements in our modern economy. Alden's analysis doesn't stop there. As she discusses the potential of Bitcoin, a decentralized digital currency, she offers a glimpse into a future where financial transactions could occur as swiftly as everyday exchanges.
And kind of going back to the prior point, um, inflation is like this invisible thing that's around us that I think this people fully don't appreciate kind of the magnitude of it because technology and productivity alone should over time lower prices of most things. The general
Mm,
direction of prices should be down when compared to like, the amount of hours you have to work or compared to like a finite unit. And what central banks do in the modern era is they try to expand the money supply either through encouraging bank lending, fractional reserve bank lending, or by monetizing fiscal deficits. They try to support money supply growth such that it overrides that productivity driven and technologically driven deflation that would occur. And so in the developed world, for example, you have something like an average of 7% annual broad money supply growth,
mm,
and when you kind of look down the stack of what prices do in that environment, you have super scarce things like fine art and waterfront property generally go up in line with this money supply growth. Then you have semi-scarce things, gold, oil, houses, beef, kind of like things that are either energy intensive, labor intensive, healthcare, education, things like that,
mm,
childcare. Those go up at maybe 4%, 5% because we are getting better at making them or we're figuring out how to make more of them, but not at a very quick rate. So they're at a slightly lower price growth rate than the broad money supply, but still quite positive and still above CPI. And then the CPI calculation itself is weighed down by all sorts of long tail deflationary things. So we get exponentially better at electronics, or we get exponentially better at software, or we outsource things and industrialize things, and that makes things way cheaper, or we do substitutions, right? So if people eat ribeye and that gets too expensive, and then they switch over to ground beef, and that gets too expensive, and they switch over to chicken, that gets too expensive, so they switch over to soybeans. The CPI is inherently a recursive function that takes into account consumer substitutions into cheaper goods if certain things get too expensive. So the combination of all those things makes it so that the true basket of what people want to buy if they could is generally above the rate of CPI growth,
mm,
but it's hard to measure, and it's just kind of this opaque system that they're in that in some ways is inherently unnatural. And the second ramification of that is that when most people think of inflation, they think of the damage it does to savings. Like you're holding the money and the money gets debased, so you've kind of
mhm,
like retroactively lost some of your time. But another thing that goes underappreciated is the unit of account that your income or your business income is denominated in. And
mhm,
especially, kind of speaking to your audience of progressives, obviously one of the groups that progressives generally care about is like the worker, the middle class, the working class, you know, people that are not in the top couple percent necessarily, and a lot of them have incomes that are denominated in units of that local currency. And the challenge with constant inflation, especially when real inflation is a little bit above what the actual CPI
mhm.
is that they have to get a raise every year just to keep up with that inflation, and the burden of effort's always on the entity trying to change their wage. right? The one
Mhm.
with the status quo has a natural kind of negotiation advantage. And so you see people generally moving jobs unnecessarily because that's one way that they kind of reset that anchoring bias.
Mhm.
And a recent example of being in Egypt is, so their money supply is growing at about 20% a year. Generally in
Mhm.
developing countries, you'll see a higher rate of money supply growth to varying degrees depending on how kind of well run that country is. But theirs is about 20%. And they just recently did a dollar devaluation. So they cut their currency in half relative to the dollar. They were trying to support it at a current level, and then due to a deal with the IMF, they had to devalue their currency.
Mhm.
And so if you go around and ask how many Egyptians were able to get a 100% raise based on the fact that their currency was just halved, the
Mhm.
answer would be that 99 plus percent of them could not, right? So now
Yeah.
on an ongoing basis, um, their wages are not growing at 20% a year in line with the money supply growth. Their
Mhm.
wages did not double when the currency got cut in half. And so the vast majority of them are making fewer dollar equivalents than they were before this decentralized decision to devalue the currency. And of
Mhm.
course, that's an extreme example, but you see the same general thing in developed countries where if you have an average of, kind of the desired basket of goods going up 3, 4, 5% per year on average, the starting point of your wages keeping up with that is 3, 4, 5%, let alone any additional raise you should get for seniority, better productivity because you're more experienced.
Mhm.
And so I think that the ongoing dilution of units that you're paid in is like a under researched, under like a misunderstood area, and that the importance of that is so it's higher than just your savings being debased. It's your ongoing kind of contractual income streams. So I think that if there's a way out, it's something like Bitcoin. So
Mhm.
it's not to say that Bitcoin is guaranteed to be successful, but it's to say that if Bitcoin is not successful, I don't really see like a second way to do it. Realistically, is
Mhm.
is probably the pessimistic view. And one thing I kind of cover a lot in the book is and somewhat indirectly is the idea of technological determinism in the sense that the invention or deployment of certain technologies generally has a bigger impact than political decisions because political
Mhm.
decisions are local and temporary, whereas technology permanently can change things and also can permanently change incentive structures for what sort of political things are even workable.
Mhm.
And so the big example I use in the book is that in the second half of the 1800s they invented and more specifically deployed the telegraph system. So they
Mhm.
deployed the telegraph across Europe, across America. They in 1866 they ran it under the Atlantic Ocean. So then you had instant communication between two continents. By the early 1900s they had it across the Pacific. And so that's kind of the time frame for when the world entered what we can consider kind of the modern era, the telecommunication era of global instant communication, and that enabled instant transactions as well. Banks and various financial entities or customers on their behalf could communicate with each other and agree on transactions. And at the time there was like the gold standard, and gold itself could not physically settle at anywhere near that speed. I mean, basically it had to be transported securely and they had to be verified. That's a much slower process. And so what that technology did was it basically gave banks and central banks and policymakers a lot more leeway because gold had to be abstracted so much to keep up with credit.
Mhm.
And that gave kind of these monopoly powers to central banks and the banking establishment. And so that's kind of how we ended up in this world of 160 different fiat currencies. If you're lucky, you're born in like the world reserve currency or one of the top 10 currencies. If you're unlucky, you're born in like the long tail of these currencies that go up in supply by 20% per year, which makes it very hard to accumulate capital,
Mhm.
or save, or have a currency that's accepted anywhere outside of your country. And the only, I think, credible way to kind of more persistently go against that is the invention of digital settlements, basically settlements that can occur as quickly as transactions can.
Mhm.
And I think Bitcoin is the first and still basically only credible way to do that in a decentralized way. And so then it becomes a matter of, is it robust and strong enough to slowly gather more and more of that monetary energy? So when you look at an emerging market, as they start kind of misusing their ledger and their ledgers falling apart, more and more people in that country gravitate towards dollars or gravitate towards other types of money. and then that reduces the monetary power of the printers. Like
Mhm.
they print and they get the consequences much more quickly because people are not really holding a lot of their value in that money anymore.
So let's recap. Lyn Alden sheds light on the intricate world of economics, inflation, and the future of currencies. Alden emphasized the critical impact of fiscal awareness in our voting decisions, especially in a world where politicians often promise without clear financial plans. She explored the hidden complexities of inflation, pointing out that constant inflation not only erodes our savings, but also puts pressure on workers to demand raises just to keep up with rising prices. Moreover, she highlighted the significance of the unit of account our income is denominated in, showcasing the challenges faced by the working class due to ongoing currency devaluation. Alden then delved into the potential solution, Bitcoin. She argued that Bitcoin, as a decentralized digital currency, presents a credible way to counter the challenges posed by traditional fiat currencies. By providing instant transactions and settlements, Bitcoin has the potential to reshape our monetary landscape. Alden underlined the importance of technological determinism, emphasizing how innovations like the telegraph system in the past and Bitcoin in the present can fundamentally transform our financial structures. If you found this discussion enlightening, don't forget to like, share, and subscribe. Stay tuned for more thought provoking content. See you next time.